Now we pivot from the U.S. internally, and then we're going to look at U.S. exports and what's happening abroad, just to look at spreads and where some of the underlying demand looks to be coming from, new supply. So when we look at U.S. crude and product exports, you can see that gasoline had a little bit of a bump of 121,000 barrels a day, up to about 85,000 barrels above the 5-year, which is something that we were expecting to see, just because naphtha still remains short and fairly tight in the European markets. And a lot of that is either, you could say gasoline blend stock versus where some of this, the naphtha market looks. But then on the disty side, we continue to see some of this slowdown, which we had some of a little bit of a recovery, but again, we think that there's that additional pressure on the distillate side, especially when you look at what's happening in Europe. So distillate exports fell 218,000 barrels a day, down 210,000 against the 5-year average. But then when we look at propane had an increase of 206,000 barrels a day, up 600,000 against the 5-year. Again, that's going to remain strong, very robust. And now versus last week, as we were saying, 1.9 million barrels a day for exports was low, even for us. And so we were expecting it to be closer to that 2.6, 2.8. And here it came in today at 2.66 million barrels a day, which again is right in that sweet spot of where we're thinking a lot of this is going to be. The problem is Asian demand still remains slow. There's more essentially price pressure if you look at some of the countries, Middle East, competing a bit more into Europe. So again, that's going to keep U.S. exports capped when you look at Asia and Europe, which again is going to keep and tamper down some of that additional flow that I think was hoped for as we went into and things reopened in Europe, and it's just not really coming to pass. But just as a reminder, 1.8 million is kind of the floor, and then just based on that is just going to be based on spreads, underlying a capacity to get out into the market. So when we look at WTI versus Dubai, it's gotten a little bit better, but again, it still remains fairly off. It should be closer to about, let's call it, a $2 spread. Instead, it's closer to about $3.50. This is still going to keep, you're going to see more Middle Eastern demand, more Middle East crude moving, less WTI, less Brent. But this is starting to see some of that balance come back into the market, which again should be supportive as we go into September, depending on how this looks. But then remember, as we get into September, you have really the end of cooling demand in the Middle East that puts more crude on the water. And we do have, again, the progress on the OPEC Plus deal that puts more supply into the market in general. So then when we look at Dubai, Brent versus Dubai, something very similar. It's essentially moving lockstep at this point in time, which is just keeping some of that capacity capped within the U.S. and within Europe. Versus and trying to incentivize more movements of Middle Eastern crudes into the market. Now we have seen some pickup in West Africa. It's at a bit of a lower price, but again they're just trying to move some of this product into the market, and some of the guys in Asia are just picking up some well-priced crude, just given where they are against the current dated Brent. So then when we look at gasoline exports, you can see that bounce off of the 5-year average, still back below the top of the cloud. As we were saying, we expect to stay above the 5-year average, but not, again, setting new seasonally adjusted highs, just really going sideways as more of that blending, and we could call it more petchem feedstock, continues to move into the market from the U.S. into Europe. Now, when we look at fuel at Disti, you can see that we're back down to the lows, the bottom of the cloud. We just expect to be kind of bouncing back and forth between the bottom of the cloud, just below the 5-year average as we go through the remainder of the summer. And then when you look at crude exports, you can see that we had a little bit of a bounce, still right where we're expecting it to be. And then when you consider where we are across the 4-week rolling average, So the 4-week rolling average is now down to 2.38 million. Too low. Again, we're expecting this to settle off between that 2.6 and 2.8. So just essentially see this curl back up and settle just in that level, and that's where we think we're going to be through the end of August, and then we'll try to reassess in September. But it's something that we think is going to be a fairly steady number, just given where spreads are, where volumes are. We're coming into the shoulder period, which again is going to see a decline in just general oil demand on a normal level, and then throw in COVID and some of the other issues. So this is going to keep, and by other issues, I mean economic slowdown in just general spending, as we talk about in the Econ Show on a weekly basis and try to review. So that's going to keep us really fixed in that window. So then when we look at propane, still banging around at the seasonally adjusted all-time highs, going to stay strong, going to remain elevated. A lot of demand still remains in Asia, even though there's that slowdown on the economic level. Naphtha prices, condensate prices, still elevated, still supporting additional movement of propane into the market, LPG into the market. But when we look at Korea coming back on a bit, that'll put a bit more naphtha in, put a bit more condi in. This will provide some of those adjustments in general. So then when we look at crude in Europe, you can see that it had a big drop, but now we're back to really that 7-8 year average. As we've been saying, we don't expect it to go up or down all that much, but just waffle back and forth. There's additional cargoes coming into Europe. There's some of those slowdowns in terms of what's being sold. So that's going to keep some of this onshore storage fairly elevated, but not elevated in the sense we're going to the highs, just right around this average as we go in. The problem is you typically get that drop in the end of August, and we just don't see that drop happening, which again is going to, as we go sideways, the comps are going to get a little bit easier, and that's going to make things look a little bit worse, but it's really not. It's just we're not seeing much movement up or down. Now, some of the official India sales, just to give some highlights before we go into the loading schedule. India oil demand was at 16.823 million tons in July, which is down 6.5% versus July 2019, but up versus 2020 by 7.9%. Where did we see some of those increases? So when we look at diesel was at 6.141 million tons, which is down 10.2% versus 19. Again, diesel is where we continue to see some of those slowdowns. And when you think about just size, because diesel demand was 6.14 million tons, gasoline 2.6. So even though gasoline at 2.63 million tons was above 2019 by 4.2%, that's, again, a positive. The diesel side is the bigger overhang. It speaks more to that longer-term economic struggle, which we're going to cover in more detail in segment 5 of the Econ Show, because India is starting to see some of that slowdown after this bump from, post lockdowns coming back to normal. LPG can't stop, won't stop. 2.367 million tons demand, 6.7% above 2019. And then that's, again, continuing to see petcoke, same thing. So you're getting the idea. And then naphtha, though, naphtha was at 1.214 million tons, which is 17.1% below 19. So you're seeing more LPG, less naphtha, and that's going to adjust a bit, but it just shows you some of the stickiness within the LPG imports into India. So now when we look at the floating, the loading schedules, where we see things going, when we look at what's happened in Libya so far, so output from Libya's Waha oil company will be cut by about 60,000 to 70,000 barrels a day following a leak that was discovered 2 days ago, which comes after they had seen record prices. So when you look at what is essentially waiting to be finalized, you can see some of that slippage from Nigeria, from Angola, from August into September. But you can see that things really slow down in August, and it's just because there's just not as much demand, speaking from the OPEC side of the West African. Because remember when we were talking about compliance last week, we saw that Angola was 257% in compliance. Nigeria was 178% in compliance, and it's less about They want to be in compliance. It's just we're not seeing the same type of demand, which is keeping some of this, some of these cargoes stuck. But one of the things that we have seen is a little bit of an increase in just the amount of demand coming from West Africa. So to give you an idea, Angola's oil for September loading is gradually clearing now that we're starting to see some of that movements, though some cargoes are being offered back into the market, which is the problem. So the reoffers are coming in. And if you think about when a lot of these cargoes were purchased, it was when things were a little bit better in Asia. And as that's deteriorated, you're having some of those reoffers, which is putting some of that pressure back in. So we're not seeing it on the loading schedule because technically it's already been sold, but it's still getting pushed back into the market, which is capping some of that. So the Congo sales are starting to pick up, which is a positive. And then when we look at Angola is yet to sell 3 to 4 cargoes for September loadings out of 34, which drops from 10 to 12, but they're facing more of those reoffers. And then when you look at, China has slowed down, so Angola's going a bit more into India, a bit more into the ASEAN countries, and less into China in general, which is putting some of the pressure on just general spreads. And just looking at some of the pieces, so Vital withdrew an offer to sell 950,000 barrels of Gabon at $250 less dated Brent. And it's just because they put it out there, just not getting any kind of bid, so they're pulling it off because they don't want to go much lower. So they're just taking it out of the market to put it back in, trying to play to see if they can get someone bite. Exxon, when we look at against dated Brent, offered to sell 950,000 barrels of Paz Flor crude for September at $1.65 less dated Brent. It was initially at $1.10 less dated Brent. So when you look at Exxon withdrew an offer to sell 950,000 of Dahlia at less $1.75 less dated Brent, which was initially $1.50. So again, seeing some of that weakness come back in. Angola has yet to sell. Then when you look at Urals got cheap again, which is what we've typically seen, where Shell is bid 100,000 tons of Urals for September delivery at $2.65 dated below dated Brent. And it was initially at -2. Glencore offered 100,000 tons of Urals at -220. Again, previously was 2. And then Gunvor, same thing, offering it at -220, 235. So not only are we seeing pressure on Urals, we're seeing some of the pressure in the ESPO remain. Not the same level. Like as we were saying, we saw some of the premiums come off. It has stopped coming down. It hasn't really bounced, but again, it's seeing some of that support, which just means that they found kind of a good clearing price at this point, which will pull some into the U.S. as well into Asia. But when we look at some of the most recent levels on OSPs, Kuwait put out an OSP. It's a little bit cheaper into Europe, a little bit more expensive into the U.S., but still just kind of playing the game when you look against seasonal averages. So now when we look at inventories, so when we look at what happened in Fujairah reported 19.349 million, which rose 422,000 barrels, with the total stock increasing 2.2%, which it doesn't reverse all that much from last week, which saw a draw of 2.02 million. So light distillates, including gasoline and naphtha, rose 37,000 barrels. This is the one that we think will continue to grind higher, albeit slowly. But when you look at, in general, what we've continued to see is east of Suez gasoline continues to come under pressure from a weakening, that U.S. demand side, which when you look at just where some of the flows, so we're still seeing some of this come into the U.S. It's just coming into the U.S., or I should say into the Atlantic Basin at a bit slower level. So when we look in terms of what is going to happen going forward, again, it's just going to be a matter of, where does this go into Europe, U.S., and how does that light distillate get taken down? Where middle distillate fell 147,000 barrels to 2.989 million. This is a reversal of last week's gain. This is the one that we think is going to have a little bit more of the upward swing. as we come into September and some of that demand for electricity declines, putting some of that, but they've also been able to export a fairly stable amount with maintaining a little bit lower refinery runs, which has kept this a bit lower than I was expecting, but something that will start to adjust. And then when you look at heavy resid, rose 532,000 barrels, which is just up by 5.2% in the Middle East. And that's just because there was a little bit slower demand. And when you look at global trade, you're starting to see a little bit of a pressure point and it's not because there isn't demand for shipping. It's just there's not as many ships moving. They're stuck in port. And that's keeping that a little bit, that overhang in Fujairah. So as we've been saying, we had that big spike of crude oil on water. Excuse me, but again, as it spikes back up, then it comes back down to that 5-year average, and you're seeing some of that get taken down and moved into that land onshore storage. It's right now, there's still an elevated amount onshore, offshore. Oil in transit has come down, which is really what drove this, because oil in storage went up. And if you remembered, we were saying the last few weeks, as oil in transit increases, as it shows up, it's going to have that timing delay. You're going to see the increase in floating storage. And then what are going to be the issues that are going to essentially slow down some of that demand when you look at the Asian markets? So here's that drop, just below the 5-year average on oil in transit, still above those lows. But you can see, again, you're still seeing some of that move from oil in transit, and it's being pivoted into oil in floating storage. So you can see that big shift up. Typically, and if you're looking at 2016, 2017, 2020, we typically have, even 2018, you typically have a fairly steady decline as you go into the end of September. But instead, we're actually at a counter-seasonal build. This will get worked off over the next few weeks, but you're just seeing how slow it is to come down. And when a lot of some of the more bullish individuals look at only floating onshore storage, they miss some of the replenishment that's going to come from the floating side. So now when we look at what happened in Europe, you can see that there was a small decline of inventories in gasoline, naphtha, with some a steady build in gas oil. We expect gas oil to see a bit of an increase, but a big increase in fuel oil, which is going to be one that we're going to talk about in a minute. So we do have more shipments coming from the Middle East and Asia, which is going to keep this moving up and closer to that 15-year average. Again, it's still going to be below average. It's still going to be fairly strong, offering up opportunity for refiners to continue to operate and move product from, again, the oil side into the gas oil side. So this will continue to shift higher. Then when we look at gasoline, this is what we were expecting to see this level off a bit. Instead, we continue to see it move down, and it's really because exports have remained fairly elevated versus what I think the market would dictate. Obviously, there's some of that arb that remains open, but it has tightened up a bit. And so right now, shipping still remains fairly cheap, which allows some of the movements. But this is one that we expect to see some of that adjustment. And then when you look at the 15-year average, you can see there's typically a drawdown into November. It's just a lot of that was pulled forward. So we think it's at this point now going to be more of a sideways move, coming closer into one of those seasonal norm, not without a big increase, but just stopping essentially just maintaining the chevron pattern, again, going sideways. Fuel oil, right back to the highs. This is one where we're expecting to see a bit more recracking, a bit more shifts in terms of some of the movements on the fuel oil side. But this is one that we expect, again, to just go sideways, not break to new highs or break down to the 15-year average, but again, just more of that sideways move in general. So then when we look at Singapore had a draw of 500,000 barrels. It was driven by residual, which was about 500,000, but fuel oil, middle distillate had a build of about 300, with light distillate coming down just by about 200. So again, just more of this level off. And as you see that demand in Asia come down, that's going to put more of this more export pressure. Because remember what we were talking about in June and July, we were expecting to see a drop in Chinese exports and some of these Asian exports. And because of COVID, because of some of the restrictions, we're actually going to see that reverse, and we're going to see an increase in some of these exports coming from China into the international, China and Asia in general, with some of that and making its way into Pad 5 of the U.S., Atlantic Basin, but also into storage, which is just going to keep this elevated, but again, moving sideways. And here's where starting to get that shift back up in middle distillate, right around that 15-year average, not too much changing. And we expected, again, to see that steady increase over the coming few weeks with light distillate just going sideways in general, as we see, maybe a little bit higher, a little bit lower, but we don't expect to see higher highs or lower lows. It's just going to stay within a fairly fixed pattern. When you look at time spreads, just looking at Brent, you can see that there's been some pressure that's continued to come in. So we've fallen from that 0.8 to about 0.35 back to where we were essentially in the March and April period. We don't see too much adjusting. We'll look as Brent rolls and CRUDE and WTI rolls, we'll continue to look at some of these spreads and what are they indicative of as we look to the refiner. Here's when we look at December versus December. You can see that we've come back to where we were middle of July. We expect it, instead of it coming further down, just because there is a lot of that bullish sentiment in the system, we think it's just gonna again go sideways from this point without too much move down or up. But when we start looking at refiners, you can see that there was a big reversal in some of those refiner numbers on the crack spread side, where we started to see some of this benefit, and then it was essentially a straight move down. And Singapore still remains firmly negative, and that's more a mixture of both just low demand, where crude spreads are, but again, this is keeping some of that pressure in there. Then when we look at Singapore, Dubai hydrocracking margins, back down to the seasonal, the all-time lows, or at least the last 5 years, just speaking to the pressure within the hydrocracking world. Urals, something similar. Still positive, which again, when you look at demand in Europe getting a little bit better, some of the availability and storage, and where some of the cheapness or some of the discounts coming into the Ural side, that has provided some support on the European cracking. But then when we go to the Mediterranean, you're seeing some getting closer and closer to the negative side on cracking. So Northwest Europe a little bit better, Mediterranean a bit worse. And that's where we're going to continue to see some of those pressure points in general. Now, when we look at Chinese imports, when you look at supertankers, it's right at the 5-year average, and you can see the 5-year average typically moves down, and we expect it to follow the seasonal norm. It's just obviously going to be lumpy, so you're just going to see this decline just given where things are. Some of these guys are coming out of turnaround, but then you have COVID with Sinopec talking about cutting 5 to 10% runs. Teapots have come down a bit. That should stay at these levels, but as the state-owned guys start to cut some of their runs, that'll reduce some of the underlying demand for crude into the market. Here's where run rates for independents went from about 70% to 68%. You can see that on the state-owned side, these haven't been updated, but just we're going to see 5 to 10% shaved off of some of those locations. Again, shrinking some of that oil demand, increasing some of those refined product exports, which is putting more crude on the water. So when we look at Asian floating storage, you can see we're moving back to the highs of 2021. I don't think we'll take out the April highs, but you're getting an idea that we're getting this big reversal. And then we're going to see this pretty steady drawdown. But it's going to be a steady move, and it's just going to be, a little bit lower highs, but then at the same time, higher lows. And we think that essentially the band is going to tighten a bit just because there will be more crude showing up, and there's just that less demand. They have issues at the port. Another port was shut down in China. Again, that's just going to create more difficulty when we're looking at offloading some of this product. North Sea had a little bit of a bounce, and as we were saying, we expected it to just kind of sit within this level, going sideways. And as you look at the 5-year average, it normally comes down, so the comps get easier, and we're going to fall back within the seasonal norm. But when we look at West Africa, we're seeing some of those cargoes start to move. So based on that, we're going to see the realistically stay at the higher end, but maintain more of the 5-year average as we go through the end of August. And then when we look at the Middle East, you can see that we keep trending up, and we're now back at the highest levels in 2021 for floating storage, which is speaks to the amount of new crude coming into the market from the Middle East. We had the adjustment in the OPEC agreement. We have Kuwait, UAE, Saudi Arabia putting more out in the market. We have Iraq putting more out. So again, this is putting some of this additional capacity in the market and increasing some of the floating storage. Now, if you look in 2020, we had a steady increase and then we had a sharp drop off. So we're going to want to see how this clears into August, because the same thing played out in 2017. So we want to see if it continues to trend up. Based on what I'm seeing, some of the data, we expect this to trend higher, but not so much, exploding higher, just not really drawing down. And again, seeing some of that elevated levels remain in the system, which just based on comps becomes a bit easier. So Europe had a little bit of an increase. Again, that we don't see too much up or down. That timing delay remains pretty fixed. So we still expect a fairly steady move as we go into the end of September, the end of August. China, pretty steady, not too much, no real drawdown. Everything kind of stayed the same. Within Shandong, the bigger issue is on the fuel oil side, where we now have a new seasonally adjusted all-time high of fuel oil in storage. And this is where, when you look at new crude coming in, keep maintaining some levels, this is where we're going to see some of the friction. How do they clear this out? How do they try to manage their system? Because remember, fuel oil doesn't have the same export quota restrictions. I mean, they have limits, but it's not to the same level that they have for gasoline and diesel, which again is going to shift some of those adjustments. So this is going to be one to watch, because this could easily get pushed into the market and result in some of those elevated numbers that we're talking about within Singapore and coming into the Atlantic Basin. So this will be something to watch on a recrack level as well with Shandong, or I should say independents, selling to the state-owned. So instead of the state-owned guys buying more crude, they'll buy fuel oil from Shandong or the independent refiners, recrack that, and try to manage some of those flows, because we continue to see headwinds on Chinese demand and imports. So we covered a lot. If you have any questions, want more clarity on anything, please let us know. My Twitter handle is @MarkFNY, and then you can obviously leave comments in our comments section. So we love the back and forth. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.